I have the pleasure of introducing my two colleagues here at UWorld. Nobody better than Shar. She's going to take you real far in a second. And then Megan, I'll have you say hello, but Shar, take it away.
Yeah, just good afternoon, everybody. You are in the right place. So if you just showed up and heard some music going and see Peter DJing, you are in fact here for Consolidations. So really excited for you all to be here on behalf of UWorld. As Peter mentioned, he's going to be teaching the lecture today. Dr. Megan Burke will be in the background answering questions, and then you will see me more on the end of the session to talk about some great discount opportunities exclusive for joining today, a little bit more about the UWorld course package and offering and what we can do more than just consolidations to get you to pass the CPA exam. So welcome today.
And Megan?
Yeah,
say hello, Megan.
Yeah, I'm Dr. Megan Burke. I'm here at UWorld as an instructor and a content developer, and I'm also an associate professor at Texas Woman's University and a CPA, right? And as Pete says, we're Megan CPAs. And I'm here to answer all the questions in the background so Pete can stay focused on you. So as you have questions, just type them in the panel there and I'll be here making sure you get some answers. And really, I just come for the DJ session, so I'm excited to, get started. Let's go, Pete. Let's go.
Megan's got the brain power in the background. She's got the brain power. So yes, welcome aboard, folks. So we really appreciate you taking the time to join us today. I know this is a free event monetarily, but it is certainly not free in terms of your time. So you are going to get 2+ hours of an intense lecture on consolidations. Little bit of multiple choice, but really I want to show you like how to apply this at the highest level task-based simulations. Some of you may not have seen this at all. Some of you may not have seen it in a while. Some of you might be in school right now in intermediate 2 or advanced accounting, wherever they're teaching it these days. So I'm going to take the conservative approach, though, that you remember nothing or have learned nothing about consolidations, okay? So again, it's a little sample and an opportunity. We want you to try it before you buy it, who we are, what we're all about. As Shar mentioned on the back end, folks, is a thank you for attending. There will be a discount code, so you're going to want to stick around for that. But away we go with consolidated financial statements. Now, before we get started, leading into consolidations in our text and in our course are different types of investment. You could buy fixed income, debt, a bond. You might buy preferred equity. You might buy common equity. So what we're going to focus in on today is common equity. Because if you're going to consolidate those financial statements, you're only going to do so if you have control. And if it's control, it can't be preferred equity because as a general rule, you have no voting rights. And it's certainly not fixed income because debt, bondholders don't get a chance to vote. So we're going to look at situations where generally you own more than 50%. But keep in mind, folks, the percent you own is evidence of how much influence you may or may not have. Okay, we're looking for the buzzword. So I'm just going to remind you. When you buy common stock, if you own less than 20%, folks, then we're going to account for it as a trading security, also known as held for trading. My international students, they call it fair value through P&L. The key thing is, if you don't have significant influence or control and you classify it as held for trading, a trading security, when you buy it, it's operating cash outflow. When you sell it, it's operating cash inflow. But most importantly, you're going to mark it to fair market value, and all gains and losses, realized or unrealized, are flowing through that income statement. In addition, dividends are income, folks. Dividends are income. All right. Now, very important, folks, own between 20, at least 20, usually up to 50%. Most importantly, though, you have what's called significant influence. Now, you might own 18%, but they tell you, hey, you've got significant influence. Or they might tell you own 25%, but you don't have significant influence. Remember, the percentages are evidence. Look for the words in the facts, okay? Do we have significant influence? Because if you do, you're going to use something called the equity method of accounting, which I will review with you, because you need that in 2 places. Whether you consolidate or not, when you have at least significant influence, you've got to learn how to do the equity method of accounting. Because when you have control, evidence of control is you own more than 50%, then you will see that before we combine the financial statements of the parents and subsidiary, on the parents' standalone financial statements, before they consolidate with the subsidiary, because they're each keeping their own income statement, balance sheet, etc., the parent internally accounts for that investment in the subsidiary on their own balance sheet and income statement using the equity method of accounting. A lot of the elimination entries you're going to learn are getting rid of the equity one-line accounting. Hell, I don't want to see just investment in subsidiary. Hell no. Show me all their assets and liabilities. I don't want this one line on my income statement called equity earnings and affiliate. What the hell is that? Is that sustainable, unsustainable? No. Get rid of that. And instead, show me their revenues, expenses, gains, and losses. Okay, so you got to know that equity method of accounting. But today, we will focus in on Consolidate, because it is a great day to consolidate. So here we go. So consolidated financial statements. We're going to focus in on a consolidated balance sheet. All right, that's where a lot of the emphasis is. But the key thing is, when you consolidate, instead of having that one line item called investment in subsidiary, now I want to get rid of that. So we're going to eliminate the account called investment in subsidiary. We're going to get rid of that. And instead, what are we going to combine? 100% of the subsidiaries, assets and liabilities. Okay, so you're going to see that one line accounting we're going to get rid of. And instead, we'll pick up all their assets and liabilities. When you consolidate an income statement, you have something called equity earnings in that affiliate. On the parent's standalone income statement, you have equity earnings in affiliate. Now I want to get rid of that. And instead, I want to include that subsidiaries, revenues, expenses, gains, and losses. And should we not have a 100% owned subsidiary, I want to let the world know that, hey, some of that income belongs to the minority interest, the non-controlling interest. That will be deducted on the consolidated income statement when arriving at consolidated net income, because that portion of the income belongs to outsiders, okay? So consolidated balance sheet, consolidated income statement, the bulk of our focus is going to be on that consolidated balance sheet. So look for two situations on the exam. How do I know I'm going to consolidate? What's the magic word? Effective control. Either they tell you we more than 50%, or they tell you controlling interest, or we are the primary beneficiary of a variable interest entity. Internationally, sometimes they call it a special purpose entity, okay? Either you see that, you're thinking, I got control. What am I going to have to do? Consolidate. Now, I want you guys to write down with me. The eagle is in, baby. The eagle is in. The book value of their equity, you're going to put that in their car, and then the eagle's coming in. You ready? So the equity of the subsidiary, we are going to eliminate the equity of our subsidiary. Their common stock, we're going to get rid of that. Their additional paid-in capital, we're going to get rid of that. Their retained earnings, the book value of the equity of the subsidiary, we're putting it in the car, so we're going to debit that, get rid of it. Any asset, when we buy that subsidiary, any asset that has a fair value greater than a book value, we're going to mark that up to fair market value. We will insert on that consolidated balance sheet any goodwill. Okay, and I'll show you how to calculate goodwill. Now, when we buy that subsidiary, I want to know not only the fair value of their assets, but the fair value of their liabilities. So assuming they have some liabilities where the fair value is greater than the book value, we're going to mark up those liabilities to their fair value. So there's your EAGL. What am I going to insert on that consolidated balance sheet? I'm going to insert goodwill. And what am I going to take off that consolidated balance sheet because I don't need it anymore, because I'm going to show all their assets and liabilities? I'm going to get rid of the investment account. That investment, that one line investment in subsidiary is out. And should I buy a company, I have control, but I don't own 100%, then what I'm going to insert on the consolidated balance sheet and consolidated equity is the non-controlling interest. So the eagle is in, baby. The first thing you do, take the book value of the equity sub, you got to take that and stick it in the car. We need to get rid of that, because rather than showing their equity, no, we're going to show all their assets and liabilities instead, and we don't want to double count. In addition, we are going to eliminate any intercompany. You can't owe money to yourself. So any intercompany receivables and payables, we're going to get rid of. One company's accounts payable, how do we get rid of a liability? With a debit. Is the other side's account receivable. How do we get rid of an asset? With the credit. And should we have an intercompany sale of PP&E or inventory, which I'll focus in on right now, we're going to do an adjusting entry to get, you can't sell to yourself. So how do we get rid of a credit to sales? With a debit. How do we get rid of a debit to cost of goods sold? With a credit. And this you're going to see is your plug figure. And then what are we going to credit? Inventory. For the amount of profit we need to de-recognize. Okay, we will credit inventory for the amount of profit we need to de-recognize. If that inventory hasn't been sold to outsiders, then we got to de-recognize any intercompany profit. But this is it. This is kind of like the big high-level overview. I just gave it all away. But this is what we're going to do. All right, so this is fun stuff. Damn it. All right, consolidated financial statements. You ready? Why do we do this? While they're separate legal entities, they are under what? Common economic control. We're going to treat them as if they're one entity because the shareholders of the parent control that entity. So we don't want any off-balance sheet liabilities because parent, you are economically responsible for those liabilities. And the analysts working on Wall Street need to have full transparency that if the subsidiary doesn't pay that debt, you're on the hook. All right? So because they're under common economic control, US GAAP requires what? Consolidations. Now we consolidate differently under US GAAP versus what you do internationally, okay? Under international rules, my IFRS friends, if you're sitting for the CFA, you could do full goodwill or partial goodwill. There's no partial goodwill here. So make sure you learn in the US rule what we're gonna do here today, full goodwill. Remember, each company maintains their own individual financial statement. It's income statement, balance sheet, cash flow. They keep their own stuff. And the parent accounts for that investment in subsidiary using what method of accounting? Equity method, which is also known as one-line accounting. The analysts don't like that because what we see is equity earnings from affiliate. What are those earnings? Are they sustainable, unsustainable? I have no idea. And if we see investment in subsidiary, but I don't see their assets and liabilities, it is very possible the analyst could understate the risk of financial distress of that parent company who's on the hook for those liabilities, as you're going to see. All right, so parent financial statements. How are they going to account? They account for that investment in subsidiary using what method? Equity method. So on their own standalone financial statements, they will account for that investment in subsidiary using the equity method of accounting. Now, when you see equity method of accounting, folks, we do not mark to fair market value. Hell no, we're going to calculate our own ending carrying value. We do not mark to fair market value. And dividends are not income under this thing called the equity method of accounting, which I will go over with you in great detail. All right. So the parent has their own balance sheet, their own income statement. Within their balance sheet, they have a single line item called investment in subsidiary. We got to get rid of that. On their income statement, they have an account called equity earnings from affiliate. We're going to get rid of that, greater transparency, and replace the investment in subsidiary with the assets and liability of the subsidiary, 100%. The earnings, get rid of that single line item, replace it with the revenues, expenses, gains, and losses of that subsidiary. Okay, obviously the subsidiary has their own financial statements. Income statement, balance sheet we'll be focusing in on. We're going to combine them as if they're a single economic entity, and we will consolidate, prepared by the parent. Okay, and this is what the investing public's going to see. All right, now the consolidation process. You ready? Balance sheet. We are going to combine 100% of the book value of the parent plus the fair market value of the subsidiaries, assets and liability. Now, I don't care that you don't own 100%. I don't care. You're saying, Pete, why am I going to add in 100% of the subsidiaries, assets and liabilities if I only own 80%? Because the other 20% will account for using an account called the non-controlling interest, which will be part of consolidated equity, okay? So combine 100% of the book value of the parent and the fair market value of the sub. their assets and liabilities. We're going to do our EAGLIN elimination entry. All right, the eagle is in, and I forgot the A. I can't spell. EAGLIN. So we're going to do that, and we're going to eliminate any intercompany transactions. Eliminate any intercompany receivables, payables, etc. Okay, the intercompany transactions they tend to focus in on. Maybe we have a sale of services. Maybe we have a sale of inventory. Maybe we have a sale of PP&E. Maybe one company's buying the other company's bonds. I'll show you how to do all that stuff. Okay, you're going to be an expert. So we're going to consolidate. All right, so sometimes they're going to ask you, hey, can you complete or correct a consolidating worksheet? Boy, oh boy, does that make good for a good task-based simulation, baby. That is not on the books of either company, so we're going to show you how to do that. We know historically, I'm old, baby, and a lot older than Megan, who's making me look bad because she's so looking young and I'm looking old. But damn, they've been doing the same stuff for a long, long time, so it's very predictable. Okay, so the consolidating worksheet makes for a good TBS. We'll see that. Doing the adjusting entries, eliminating balances, etc. What are we going to report as if the company were a single entity? Sometimes, you know, they might just look at an individual transaction that needs to be eliminated, like a sale of PP&E from one company to the other, or a sale of inventory, whatever. That could be an individual multiple choice. But if they want all the adjusting entries, the EAGLIN, etc., might more likely than not a task-based simulation. Okay, so what we are going to do here, you ready, is first look on the date of the business combination. That's going to be step one. And then step two, we might have to consolidate on a subsequent date, okay? So on the date of acquisition, you don't need to worry about any income statement or statement of cash flow, because there's been no activity since the date of acquisition, because we're on the date of acquisition, all right? So the investment in the subsidiary, your cost is the sum of cash paid plus debt issued plus fair market value of stock issued. By the way, I do a lot of writing in my classes real time. I don't read scripts, baby. We do it real time. Why? Because I need you. Look, I tell this every time I give a speech. Char's going to want to hit me over the head because she heard this 45 times already. But listen, if you go to the gym with me and say, Pete, train me, watching me on my treadmill ain't going to do nothing for you. You got to get on your own treadmill. Get your pen. Put the pen to the paper. What you write, you will remember, and occasionally speak it. Explain to your significant other how you consolidate entities. All right, because if he or she wants to consolidate this relationship, you got to make sure they're worthy of you. Look at how hard you're working. Come on, man. So your purchase price is the sum of cash paid plus debt issued plus the fair market value of the stock issued. All right, so that's how we're going to find your purchase price. All right, now, once we have your purchase price, we're going to look at the purchase price for whatever percent was acquired, and then we are going to subtract from that the fair market value of the identifiable equity for that particular percentage acquired, okay, for that subsidiary. And let's assume for right now you bought 100%, no non-controlling interest yet. Any difference between the purchase price and the fair market value of that identifiable equity is called unidentifiable excess. But we can't have something called unidentifiable excess. No. We have to make up a term. The term is goodwill. Yeah, we like our fancy words. This way regular people don't know what we're talking about and we can make a lot of money. All right, so that's going to be one of the ways we're going to do goodwill. That's number one. Number two, on a subsequent date, once there's activity, revenues, expenses, gains, losses, dividends declared, all that kind of good stuff, subsequent date, now we're going to have to do the equity method of accounting. That equity method of accounting. We do not mark to fair market value, and dividends are not income. You're going to take your initial carrying value in that subsidiary, that cost, that purchase price. Okay, that's your initial carrying value. We're not marking it to market value. You're going to add your percentage share of that subsidiary's net income. you're going to subtract your percentage share of any excess depreciation or cost of goods sold, because we're going to mark that inventory or asset from book value to fair market value. You're going to subtract your percentage share of any dividends that is not income. That is going to be reduction of the carrying value. It's considered return of capital. And there is your ending carrying value. That's how we get your ending carrying value for your investment in subsidiary. Do not mark to fair market value, okay? These two items, and really there are more, but for right now, we'll just simplify. This is what we call, when you sum this, your equity earnings in that affiliate, okay? And don't worry about any non-controlling interest, we'll get there, okay? We gotta walk before we run before we fly, all righty? Sweet. All right, now, if the parent owns 100% of the voting stock, then what do you think? There's no non-controlling interest. But if they own less than 100%, what do we need to calculate? You've got to calculate your non-controlling interest, okay? And I'm going to show you how to do that. Non-controlling interest is part of consolidated equity on the consolidated balance sheet, okay? I'll show you how to do that. And on the income statement, any earnings that are going to those minority shareholders, those outsiders, that's deducted from consolidated earnings when arriving at consolidated net income, because that doesn't belong to this consolidated group, all right? So we want to be reading very carefully. All right, now, the investment account and the subs equity accounts are eliminated, okay? So the investment in the subsidiaries equity accounts are eliminated. We're going to replace investment in subsidiary with 100% of the subs assets and liabilities, even if we own less than 100%. The 1 minus the 100%, or I should say, let's say we bought 80%, 1 minus 80%, 20%, the non-controlling interest, that'll be part of consolidated equity. All right, so how do we do that again? Pull up the card, baby. I need the book value of the subs equity, and we got to put it in the car. All right, so what do I mean by car? Common stock, additional paid in capital, retained, and take the book value, the subs equity, put it in the car. And now the EAGLE is in. We're going to debit the assets, because when we buy that subsidiary, I want to keep track of the difference between the fair market value and the book value, net of any excess depreciation that is recorded over time. It must mean a damn thing until we do it. We're going to insert goodwill on that consolidated balance sheet. We will insert that net of any impairment. If there's ever any impairment, it's net of any impairment. Any liabilities when we bought the company, if the fair value exceeded the book value, we'll write that up. We're going to get rid of that single line item, investment in subsidiary. And what are we going to insert on that consolidated balance sheet? The non-controlling interest. The EAGLE is in, baby. The EAGLE is in. That's the first thing we're going to do. And that's NCI. The more times you write it, you hear it, you read it, you'll remember it. Take the exam and then you can forget it, unless you're sitting for bar. A lot of overlap between FAR and bar. I like the bar. Are you kidding me? Not just to drink, but I like the FAR section of the exam because I like the math, man. Once you understand the math, it's black or white. You get it right 100% of the time if you know the formula. Whereas those damn theory classes, audit, ISC, there's no math involved. That's the good news. You get through it quicker. The bad news is there's no math involved. Damn thing don't add up. I don't like things that don't add up. Okay, 3 of the sections on the exam, I was in the 90s, except for audit. I didn't like audit. I didn't like when I did audit. I worked at Deloitte as an auditor. They gave me an award. They said, Pete, you are the world's worst auditor. Yet, on the CPA exam, I got a perfect score in audit. That's right, baby. A 75 to stay alive. Let's go. You got to love it. So, Megan likes the audit. Not me, man. I'm no Megan. Megan's going to do that stuff. I don't like that stuff. All right.
I'm a tax person, Pete. Come on now.
Oh yeah, she's taxing. You know, the difference is Megan at UWorld, she actually does taxes for a living. Oh, what a shock. Can you imagine you got people trying to teach tax and CPA review who've never done a tax return for a fee ever? Shit, I don't even think they do their own taxes. They're faking it, man. Faking it. Check those resumes. Come on, man. Shit. All right. So purchase price, sum of cash paid, debt issue, fair market value of stock issue. Okay, we're going to do the EAGLIN, our elimination entry. We're also going to eliminate intercompany transactions. Maybe there's a sale of services we got to eliminate. One side's revenue is the other side's expense. How do we get rid of revenue? With a debit. How do we get rid of the expense? With a credit. Maybe we have a sale of PP&E. We're going to eliminate any gain or loss has got to be eliminated. You can't sell to yourself. We got to reinstate accumulated depreciation because you didn't really sell that asset. Okay, and then we're going to plug the PP&E to balance. And what's another transaction we got to look for? Sale of inventory from one company to the other. What are we going to do? Well, how do we get rid of that sales revenue? With the debit. How do we get rid of the cost of goods sold? With the credit. But that's going to be our plug figure because we are going to credit inventory for the amount of intercompany profit we've got to eliminate. Eliminate. All right. So those are the intercompany transactions we'll be looking for. Woo, baby. All right. Following the acquisition now. Now we've had revenues, expenses, etc. All righty. So we eliminate investment in sub. And what are we replacing it with? 100% of their assets and liabilities. And any non-controlling interest will be inserted on the consolidated balance sheet. We will also insert any goodwill. The only place you will ever see goodwill is on a consolidated balance sheet. All right. Consolidated assets, folks, are going to be greater than the parent alone assets. All right. The only thing the parent shows is investment in subsidiary. No way. We're getting rid of that. I want to combine with the parents receivables, inventory, PP&E, intangibles, land, what they own plus what the subsidiary owns. Consolidated liabilities are going to be greater than the parent alone liabilities. As a matter of fact, the major criticism of the equity method of accounting, it's off balance sheet financing. We're not showing any liabilities of the subsidiary, even though we own them, control them, we're responsible for that debt. The reason we consolidate, one of the biggest reasons, is, man, all we're showing is not only don't we show a liability, the only thing we show is an asset, the net investment in that subsidiary. All right, so that we're going to get rid of that and instead pick up all their assets and liabilities. All right, big thing for us, folks. You ready? Consolidated equity. You're going to have a bunch of different ways to make sure you've consolidated correctly. Consolidated equity, one way to do it, parent alone equity, plus any non-controlling interest. All right, another way to get consolidated equity, consolidated assets. When you're done consolidating, the consolidated assets minus the consolidated liabilities. You better get the exact same result. I don't care which way you do it. Consolidated equity is always equal to the parent alone equity plus the NCI, the non-controlling interest. And again, for my IFRS fans out there, the folks internationally, under US GAAP, you got to follow the way we do it here. Okay, there's only one way to consolidate, full goodwill. We don't mess around with the partial goodwill. That's what you do under IFRS. All right, a consolidated income statement. You ready? Would be the same as the parents. What do we mean by that? You ready? Parent alone net income. Parent alone net income is going to equal consolidated net income, but with greater disclosure rather than just showing single line item, a single line item. Equity earnings and affiliate, hell no. I want to see their revenues and expenses and gains and losses. All right. So over time, once we get activity, remember, if we're immediately following the acquisition, there's no consolidated income statement. There's no consolidated statement of cash flow because there's no activity yet. But in the future, as the subsidiary has activity, the parent alone net income will be equal to the consolidated net income, but with greater disclosure. The revenues, expenses, gains, and losses of both companies are combined. Even if we don't own 100%, we're still going to combine 100% of both companies' revenues, expenses, gains, and losses. Any sub net income that gets allocated to the non-controlling interest is going to be subtracted. It'll be deducted when arriving at consolidated net income. All right, so the question becomes, has there been any activity by the subsidiary yet? If there's no activity yet, then there's no consolidated income statement or no consolidated statement of cash flow. It's more likely than not a theory question. All right, the only thing we would have to consolidate immediately following the acquisition, just one thing, the balance sheet, because that's a cumulative financial statement. It doesn't represent a period of time. It represents all the assets, all the liabilities, all the equity acquired since the beginning of their formation. All right. Now, we technically, we don't have time to do both the cost method and the equity method, but there are two ways to account for an investment in subsidiary, cost or equity. All right. So I can't cover both in this abbreviated lecture. So it's either cost or equity method. Cost, carrying value is not going to change over time. Equity method it is. We're going to focus in on equity method today. All righty. Initially, the investment in subsidiary account is exactly the same cost or equity method. It's the purchase price. But over time, there's going to be a difference. All righty. Now, after the date of acquisition, now we have to consolidate the balance sheet, consolidate the income statement, and the statement of cash flow, which we're not doing. Okay, so now we've got equity earnings that have to be eliminated. Equity earnings that have to be eliminated. Okay, on the consolidated balance sheet, we've got to eliminate that investment in subsidiary account. So there's a little bit more to do after the date of acquisition. All right, so activity now has probably occurred. So they've got revenues, expenses, gains and losses. The subsidiary has activity. Maybe they've declared or paid some dividends. Maybe there's been some intercompany sales, whatever. Okay. Now, under the equity method, which is what I'm focusing in on here today, the investment in subsidiary account, the carrying value is now adjusted from your beginning balance to your ending balance. Are we going to mark it to fair market value? Hell no. The only time we're marking it to fair market value is if it's a trading security held for trading or they designate it at fair value. Okay. Now, the parent's standalone financial statements are not GAAP compliant. Why not? Because we would lack transparency. We've got to consolidate all the subsidiaries under their control to have greater transparency. Show us those liabilities of that subsidiary you're responsible for. Don't just show us equity earnings in that affiliate. No. How did they generate it? All right. So it's kind of our introduction. So the way the course goes, folks, we lecture a little bit, then we work questions, okay? So we're going to get to a question now. All right, so investment in subsidiary account on the parent's books. Adjusted carrying value, not fair market value. So when they give you fair market value, that's going to be distractor information, okay? Under the equity method, that carrying value is adjusted over time. So we can't do the cost method, unfortunately. All right, stays on the books at original purchase price. There's no excess depreciation. Dividends are not income. Okay, so when we don't have time. We're going to do the equity method. How do we do the equity method again? You're going to take that. This is your date for tonight. Whatever you're going to do, cancel those plans. You're going to take the beginning carrying value plus your percentage share of their net income minus your percentage share of any excess depreciation or cost of goods sold when those assets were written up from book value to fair market value, minus our percentage share of any dividends, which are not income. That is not income under the equity method of accounting. There's the ending carrying value. Investment in subsidiary on parent standalone balance sheet that we will eventually have to eliminate. How do we eliminate it? Right there, the I and the EAGLIN. Okay, the ending carrying value of that investment in subsidiary account on the parent standalone balance sheet. We got to get rid of that. Okay. Now, some journal entries, folks. You ready? If it's a TBS or an individual multiple choice, they love some journal entries. So how do we record the parent's percentage share of the subsidiary's net income? Well, we debit investment in subsidiary, and then we credit equity earnings, assuming it's a profit. Okay, that journal entry would be reversed if there were a loss. Then we would debit equity earnings, credit investment in subsidiary. But assuming we have a profit, that'll make the carrying value of the investment go up. The parent share of dividends, we'll either debit cash if we got it or debit dividends receivable. We're going to credit investment in subsidiary. Why? Because that's going to make the carrying value of that investment go down. We do not credit income. Do not credit dividend income. It's the most common wrong answer choice. And then if the fair value of any assets were greater than the book value, then we have to record excess depreciation. Okay, or excess cost of goods sold. We amortize, we spread out that cost. So we're going to debit the equity earnings because this is an additional expense that makes the carrying value of the asset go down. We credit the investment in subsidiary. So we start with our beginning carrying value. We then make all of these adjustments, 1, 2, 3, and that's the ending carrying value called investment in subsidiary on the parent standalone financial statements prior to consolidation. All right, so here we go, folks. It's all about practice. So there's the words. Now do it, baby. Do it. Show me how we do it. You ready? I just want to know, man, who's having a good time? Put it in the chat box, man. Don't you feel bad for your friends and family who are not watching this lecture right now? Shit, they're missing out. Come on.
I mean,
by the way, this is Megan is loving it because she's making the CPAs, baby. She's making accountants great again. Now, passing company. Let's go. How about the students?
I mean, Pete,
anybody out there?
You should know that somebody told me, though, that you didn't look a day over 21, OG. I'm also hearing that we're going to have some Peter Olinto Halloween costumes tomorrow. So let's go. You're getting us. This is better than a live concert. And we're calling you War Eagle. Like, let's go. Somebody's
let's go.
And a day with you all week, Pete.
Listen, I forgot my headband too. So sit back, relax, and grab yourself a beer. Let me take you for a ride through the atmosphere because we're the newest and the fresh. We are the best that may teach ordinary most teaching every day. But when I'm on the mic, you know, to hear me say, when I say CP, you say, hey, you're like, shut up, stupid, and keep. All right, here we go. All right, so I got to take my medication more often. All right, so we bought 100% of another company. We got control. It's time to consolidate, and there's no non-controlling interest, okay? What we paid for this company? $200,000. So, want to keep track. What is my purchase price? Cash paid plus fair market value of any stock issued plus any debt issued. Purchase price for 100% of the company, $200,000. Okay, now, fair market value of identifiable equity, 100%. What is that number? So that's step 2. It's leading me to what I need to do next. On that date, the $150,000 carrying value of the sub is equal to the fair value of all their assets and liabilities except for equipment, which had a fair fair value of 100 and a carrying value of 80. Stop right there. So we got PP&E. The fair market value is 100,000. The book value is only 80. That is called identifiable excess, folks. Identifiable excess, $20,000. You're immediately thinking the excess of the fair over the book value has got to be amortized, depreciated over time. So I'm going to take that excess of 20,000 divided by the remaining useful life. What did they tell us? Let's see. Except for equipment which had a fair value of 180, the equipment has a remaining useful life of 4 years. I'm going to divide that by 4 years. I've just calculated my excess depreciation. Ready? $5,000. We got another piece of the puzzle. All right. Now, the fair market value of the identifiable equity. How do we get that? Well, I got the book value of the equity. They gave me that number, 150. Plus I got identifiable excess, fair value of the asset over the fair book value of the asset, 20. I've got identifiable excess, fair value of liabilities over book value of liabilities, but that's a zero. There is none. So what is the fair market value of the identifiable equity? $170,000. Okay, now we didn't pay $170,000, did we? We didn't. Why not? Why did we pay $200? I have no idea. But I can't call it, I have no idea. But it is, I have no idea. I mean, they try to say this, that, and the other thing about, you know, reputation and all that stuff. Could be here today, gone tomorrow. Analysts on Wall Street say, forget that number, man. It's nonsense. Unidentifiable excess, but we're going to call it goodwill, which will be inserted on the consolidated balance sheet, $30,000. Folks, another thing they could ask you to do is identify that $200,000 purchase price. 150 of that is for the book value. 20 of that is identifiable. PP&E has a $20,000 fair value greater than the book value, and the other 30 is, I have no idea. All right. Now, what's our journal entry when we buy this company? We're going to debit investment in subsidiary, $200,000. What are we crediting? Cash, $200,000. Okay. Investment in subsidiary, non-current assets just went up, current assets just went down. Total assets, no change. They only change form, folks. They only change form. Total assets did not change. All righty. Now they tell me, let's see, this company earned $50,000 during the year. Okay. Beginning carrying value. What's our beginning carrying value here? $200,000, our initial purchase price, plus our percentage share of the net income, $50,000. We own 100%. We are adding that $50,000. That makes the carrying value go up. Minus our percentage share of any excess depreciation. What's the excess depreciation? 5,000 times our percentage share, 100%. That makes our carrying value go down. Okay, that made our carrying value go down. Minus our percentage share of any dividends, 100%, 0 times 100%. I don't see any dividends. 0. Ending carrying value. My investment in subsidiary account, 250 minus 5, 245. That will be an asset, a non-current asset on the parent standalone balance sheet. That is a non-current asset called investment in subsidiary. Okay, at the end of the year, or whatever period of time that was. The equity earnings from this affiliate, single line item on the parent's income statement, equity earnings, single line item on the parent's standalone income statement, 50 minus 5, $45,000. You net these two items out to get your equity earnings. So on the parent standalone income statement, we see a single line item, equity earnings. On the parent standalone balance sheet, we see a single line item, investment in subsidiary. Okay, we're saying US GAAP says that lacks transparency. We got to consolidate. All righty. Now, On the exam, they love to ask you, hey, you paid $200,000. Why did you pay $200,000? Why? You ready? Why did we pay $200,000? Well, reason number one, there's the book value of the equity. Reason number two, there's the fair value over the book value for the asset. And then reason number three is really not a good reason at all. I have no idea, but I paid an extra $30,000. That is unidentifiable excess. Goodwill, here today, gone tomorrow. So the way I like to do it is I take my price paid, which is the sum of cash paid plus debt issued plus the fair market value of any stock issued. I first allocate it to the net book value, the book value of the equity. Then I allocate it to the fair value of any assets over the book value. And then whatever left over, assuming the liabilities book equals market, which is generally the case on the CPA exam, okay? Any excess belongs to Goodwill. All right. Next item. You ready? Using the equity method. Using the equity method. Investment in subsidiary is on the parent standalone balance sheet. It's on the parent, not consolidated. It's a single line item. Okay, at acquisition, the parent does not record any impact from identified basis differences or goodwill. Goodwill only appears where? Not on the parent standalone balance sheet. Okay, it belongs where? Goodwill and any difference between the subsidiaries' fair market value and book value, where does that belong? On the consolidated balance sheet, folks, not on the parent standalone books. Okay, parent's going to quote unquote track that goodwill. Is it impaired? Is it impaired? We don't amortize it. Is it impaired? If it's impaired, carrying value of that subsidiary is going to go down. Equity earnings are going to go down, as you will see if it ever gets impaired. Carrying value of the subsidiary goes down, investment in subsidiary. Okay, it's going to go down and the equity earnings are reduced. All right, to consolidate the balance sheet at year end, okay, post-acquisition, let's do it. Let's do it. You ready? We got to put the book value of the subsidiary's equity in the car. So the book value of the sub's equity, we want to get rid of that. So whatever their common stock is, whatever their additional paid-in capital is, whatever their ending retained earnings are, we got to get rid of that. Don't know that number yet. Assets, we've got to record the fair value over book value. What was the difference between the fair value and the book value? It was $20,000 minus the excess depreciation we recorded of 5, dropping the zeros, that's 15. We got to record the goodwill. What did we say the goodwill was? $30,000. Okay, we'll credit the liability for any fair value over book value. There was none. Notice I reviewed the rule in its entirety. Even though it doesn't apply, I put a 0. Investment in subsidiary account. Investment in subsidiary account. We got that ending balance. What did we say that ending balance was? $245,000. 245. Putting that number in there. And then non-controlling interest. You're saying, Pete, why are we doing that? Because we review the rule in its entirety. Since we own 100%, that's a 0. Now check this out. My total credits are how much? 245. That means my total debits better be what? 245. How much do we have so far? 30 and 15. So the book value of the sub's equity's got to be what? 245 minus 15 minus 30. The book value of the sub's equity, I bet you, is going to be $200,000. And I bet you a cheese doodle. That's right. I'll come find you when I would give you that cheese doodle. But I bet you it's 245. I'll show you how to calculate that 245 directly. Excuse me, that 200,000. I'll show you how to calculate it. All righty. But the investment in subsidiary, there's our ending balance. How did we get that? We started with our beginning balance. What made it go up? Our percentage share of net income made it go up. Okay, what made it go down? Our percentage share of any dividends, which was a 0. What else made it go down? Our percentage share of any excess depreciation. So what was that ending balance? 245. Equity earnings in the affiliate. Our share of the net income made the carrying value go up. Our share of the excess depreciation made the carrying value go down. It also makes our equity earnings go down. Alrighty, so $45,000. That's our equity earnings from this affiliate. Okay, you ready? Now, here we go. So we've got to eliminate the adjustment investment in that subsidiary. That's ultimately going to be the goal, to eliminate that. We do that with a consolidation entry, okay? So you always review the rules in its entirety. So we're going to put the book value of the subs equity in the car, baby. We put it in the car. We get rid of, or excuse me, we input any asset, fair value over book value, net of any excess depreciation, net of any excess depreciation or excess cost of goods sold. The EAGLE, EAG, book value of the subs equity, EAG. Okay, now don't forget liabilities. I always throw that in there. Okay, even though that's a zero. The investment in subsidiary account. Oh, and they have the identifiable liabilities. I'm sorry. There's the L, identifiable. Okay, so there's our L, investment in subsidiary, the ending carrying value, which gets adjusted from beginning to end. We do not mark to fair market value. And then what do we have to add in? The non-controlling interest. The EAGLE is in. The EAGLE is in. Okay. So, consolidation at acquisition. You ready? There's no activity yet. If it's at acquisition, there's no activity yet. So we got a brand new example. Let's do it. Parent company acquires 100% of stock of Strawberry in an acquisition, payment of $900 in cash. So we have control, and there's no non-controlling interest to worry about. My purchase price for a 100% stake in this company, my purchase price for a 100% stake in this company, let's say 900. Now I want to subtract the fair market value of the identifiable equity times what I bought, 100%. So I'm looking for that number. Any excess would be called what? Goodwill. At the time, carrying value of S was 600, and all of the assets and liabilities had fair value equal to carrying value with the exception of equipment that had a remaining life of 5 years and a fair value 100,000 higher than the carrying value. Stop right there. The excess of fair value over book value, 100,000. Okay. Here's the equity. This is the book value of the equity sub. Book value of the equity sub. That would be of the subs equity. I'm talking backwards now. The book value of the subs equity. Oh my goodness. You ready? The CAR. We got to put the book value of the subs equity in the car. So 100 plus 100 plus 400, the book value of the subs equity, 600 plus the excess of the fair value of the asset over the book value of the asset, 100. So the fair market value of the identifiable equity is 700. We just found another piece of the puzzle. The fair market value of the identifiable equity, 700 times the percent we acquired, 100%. So now we've got unidentifiable excess, also known as what? Goodwill, 200 bucks. Okay, that's got to be inserted on the consolidated balance sheet. So what are my journal entries? You ready? Debit investment in subsidiary, 900. Credit cash, 900. Non-current assets went up. Current assets just went down. Total assets, no change. We only have a change in form. Immediately consolidate at acquisition. Is there any income statement to consolidate? No, there's no activity yet. So the only thing we have to do is the balance sheet. All right, my EAGLE is in. So the EAGLE, got to take the book value, the subs equity, and where do we got to put it? In the car. So the common stock, 100. The additional paid in capital, 100. The retained earnings, 400. A, fair value over book value. Fair value over book value, net of any excess depreciation, but that's zero for the moment because we have not yet had an opportunity to have any time pass by. Eventually, that $100,000 excess asset fair value over book value will be divided by 5 years, and we will have $20,000 of excess depreciation, but not yet. We don't have to sweat it yet. No time has gone by. Fair value, oh, and by the way, all of this, 600, fair value over book value, 100. Goodwill, there's my G, goodwill. We said that was 200, so all my debits add up to what? 6, 7, 8, 900. Now liabilities, fair value over book value, 0. Get rid of investment in subsidiary. What was that investment in subsidiary? 900. Non-controlling interest, 0. LIN, the eagle is in, baby. All right, so my credits add up to my debits. And let me not write the word 0. Let me put the number 0. Well, my debits are 900. That's it. There's your initial consolidation at acquisition. Are you kidding me, man? They're insulting you. This easy ass shit. All right, now what do they like? A consolidation worksheet, folks. TBS. Now can you take this information and just organize it on a worksheet? Of course we can do that. We're going to take 100% of the assets and liabilities, and we're going to get our consolidated assets. So cash, added across. Equipment, and don't forget, folks, that 100, that's the fair value over the book value. That's the debit. That is the A in EAGLIN. Okay, so EAGLIN, make sure you're counting for everything. That's that 100 right there. Okay, investment in subsidiary, that's this I. Okay, we got to get rid of that account. That gets eliminated. That gets eliminated. Goodwill, we insert on consolidated balance sheet. Notice that is neither on the parent nor the subsidiary's books. Not there, not there. We have to insert it. How do we do that? With a debit. There's your G. Okay, so here's our A, there's our I, there's our G. Okay, now what are all your consolidated assets add up to? My consolidated assets add up to what? 8,600 plus 200, 88 plus 200, consolidated assets, 9,000. Okay, now put the subsidiaries, book value of their equity, put it in the car, get rid of it. So we eliminate the subs book value of their equity. There's the E in EAGLIN. So we're left with the parent only. This is the parent only equity. Now, check this out. Parent only equity. The parent only equity is how much? 5, 6, 7, 8, 9,000. Consolidated equity is always equal to the parent equity plus any non-controlling interest. Well, that's a 0. Parent equity is 9,000, so consolidated equity is 9,000. And what's another way to get consolidated equity? Consolidated assets minus consolidated liabilities. There were none. Consolidated equity, baby, 9,000. 9,000. You got check figures. We got check figures. Are you kidding me? That's it. Consolidated worksheet. We can do it. Here are our journal entries. All right. When we acquire the company, non-current assets go up. Current assets go down. Total assets, no change. Book value of the subs equity. Book value of the subs equity. There's the E. Okay. There's the E. The equipment asset, fair value over book value. G, your goodwill. Liabilities, fair value over book value. 0. Investment in subsidiary, got to get rid of this, 900. Non-controlling interest, 0. And we're good to go. We're good to go. Kidding me? Let's go. Let's go. Let's go. All right. Assume the same facts as the previous example. We acquired 100% for 900 cash. Equipment with 5-year life had a fair value exceeding carrying value by 100. Goodwill was 200. Okay, 5-year life. Take that 100, divide it by 5 years. What's our excess depreciation? Our excess depreciation is 20. However, now assume the goodwill is to be impaired. As soon as I see goodwill impaired, what's that going to do? That's going to make the investment in subsidiary account go down. It's going to make your equity earnings go down. Obviously, your goodwill is lower than it would have been otherwise. Okay, now let's do the equity method. Ready? Beginning carrying value was our purchase price, our initial cost. Okay, we paid $900 cash. Now, our percentage share of their net income, they tell us net income was how much? Let's see. Income during the year was $3,000 for the parent. Distract their information for a second, but the subsidiary was $150. $150 times our percentage share, 100%. That makes carrying value of the investment go up, minus our percentage share of excess depreciation, 20 times 100%. That makes our carrying value go down, minus our percentage share of any dividends, 0 times 100%. We got no return of capital, 0. Ending carrying value. Now we're thinking that that's 1030, but wait a second. The goodwill is impaired. It's worth only 195. What was the goodwill? Well, the goodwill was 200. So the goodwill, the change in goodwill from 200 to 195. What happens to that 5, that impairment loss? What happens to that 5? You ready? Our equity earnings, and that's a 150. Sorry, folks, 150. So 150, that was 130, but now we're going to subtract 5. What's our equity earnings from the affiliate? 125. That's the equity earnings from the affiliate. Our ending carrying value, we thought it was 1030 minus 5. What's our adjusted ending carrying value when looking at that impairment? It's actually how much? 1025. 1025. Okay, so that impairment, we have an impairment loss. We have an impairment loss of 5. Okay, so our goodwill is now 195. Our equity earnings in that affiliate is now 125 instead of 130, and the carrying value is no longer 1030. 1030 minus 5, it's now 1025. Okay, so that 5, we're reducing our goodwill, reducing our equity earnings, reducing our ending carrying value, our investment in that subsidiary. All right, so this is after acquisition. Okay, now I want to do statement of retained earnings for both companies, their individual statement of retained earnings for the parent company and the subsidiary. Okay, so the beginning retained earnings for the subsidiary, I'm going back, excuse me, for the parent company, I'm going back to this page here. Okay, so this is where I'm getting my beginning retained earnings. 5,000 for the parent, 400 for the subsidiary. Okay, that's where I'm getting my information from. Okay, so beginning retained earnings, 5,000, 400 per given information. Income during the year, parent company. This is their separate income, separate income. Separate income, not including equity earnings. Okay, not including equity earnings. So their separate income, their separate net income, 3,000 plus the equity earnings from the affiliate. The equity earnings from the affiliate, what did we say that was? The equity earnings from the affiliate, we said that was 125. 125, I'm popping that in. Plus 125, minus any dividends declared by the parent company, 0. What's ending retained earnings for the parent? 8,125. let's do the same thing for the subsidiary. They had beginning retained earnings of 4,000. What was the subsidiary separate net income? 150. Okay, they don't have any equity earnings in themselves. Do they have any dividends declared? Dividends declared, 0. What's the subsidiary's ending retained earnings? 550. Okay, 550. Now, the book value of the sub's equity, at year end. Put it in the card. Take the book value, common stock, no change. Look, folks, this is where I'm getting these numbers from, okay? All given information. Paid in capital, common stock, 100. So common stock, 100. Paid in capital, 100. And ending retained earnings, 550. So what's the subsidiary's ending retained earnings? 750. Now let's do our elimination entry at year end. Elimination entry at year end. You ready? How do we do that elimination entry at year end? The eagle's in, baby. Take the book value of the sub's equity, get rid of it, 750. 750. Assets, fair value over book value. What was the fair value over book value? Fair value over book value was 100, but net of excess depreciation of 20. Where did I get that net excess? 20, that extra 20,000, excuse me, the extra 100,000 of book value divided by 5 years, excess depreciation 20. So 100 minus 20, that's 80. There's the A. Goodwill. Goodwill was impaired. It was 200. We wrote it down by 5. That's now 195. Liabilities. Fair value over book value, 0. Ending investment in sub. What was the ending investment in subsidiary? Let's see. 1025. It would have been 1030, but minus the goodwill impairment, 1025. Non-controlling interest, 0. We own 100%. Do my debits add up to 1025? 750 plus 80 plus 195. 750 plus 80 plus 195. Now, if you're religious, you will say a prayer. And I'm hoping that adds up to 1025. Let's go. Who's better than us, baby? Nobody. Nobody. If they ask for, you see how this lends itself well to a task-based simulation? Come on, man. Now, journal entries, you ready? To account for the subsidiary's income, our percentage share, which is equal to 100%. We debit the investment in subsidiary, carrying value of the asset goes up, credit equity earnings. To depreciate, fair value over book value, 100. Excess divided by 5 years, 20,000. Our percentage share, again, 100%. Debit the equity earnings, credit investment in sub. To record impairment of goodwill, carrying value of the equity earnings goes down, the carrying value of the investment goes down. Okay, so what was the ending carrying value of the investment? 1025. Okay, 1025. What were the equity earnings? 150. 150 minus 20 minus that 5. Okay, excuse me. Equity earnings, 20 would have been 130, but for that 5. So the equity earnings would have been 130. 150 minus 20 would have been 130, but we had that impairment of goodwill. So instead of being 130, equity earnings in that subsidiary, 125. Okay, they like the worksheets, no worries. We got to do the eagle is in. You ready? Here's the book value of the equity we got rid of. There's the assets. There's the goodwill. Liabilities, fair value over book value, 0. Non-controlling interest, 0. All we got to do is organize our thoughts now. Cash added across, 3350. Equipment, fair value, 100 over book value minus excess depreciation. That's that 80. Investment in subsidiary, that's that 1025. Goodwill, the 200 minus the 5, the 195, that gets inserted on the consolidated balance sheet. What happens to the book value of the subs equity? That gets eliminated. What is that? 550, 650, 750 gets eliminated. All right, what's the parent alone equity? The parent equity is how much? 12,125. Parent equity, 12,125. What's consolidated equity? Consolidated equity is equal to the parent standalone equity, 12,125, plus any non-controlling interest, 0. Consolidated equity, 12,125. Or take your consolidated assets, add it all up, 12,125 minus any consolidated liabilities, 0. Consolidated assets minus consolidated liabilities, another way to get your consolidated equity, 12,125. All you got to do is get familiar with it. You got to work it. You got to work it. Now, without having a non-controlling interest, it's boring as hell. All right, so now we got to do some non-controlling interests. Let's go. If the parent does not own 100%, if they do not own 100%, all right, you got non-controlling interest. That is part of consolidated equity on the balance sheet, and percentage of subs net income. Percentage of subs net income that is allocated to the non-controlling interest is subtracted when arriving at consolidated net income. Okay, subtracted when arriving at consolidated net income. All right, so if we do not own 100%, then we've got to determine that non-controlling interest. Okay, non-controlling interest is recognized at fair value. There's 2 ways to back into the fair value. You ready? One of 2. They give you that the shares are traded in an active market. No problem. We'll use the number of shares owned by the minority interest times that fair market value per share. There's the fair value of the non-controlling interest. Or if they don't give you a fair value, use algebra. Yeah, baby. My sons, where are you? Why do we learn algebra? Because in case you want to be an accountant, you got to learn algebra. That's why we don't want to be accounting majors. No problem, guys. Whatever you want to, they're going to be TikTok stars, baby. TikTok all the way. So here we go. On the CPA exam, rather than provide the fair value of the sub shares, questions may require candidates to derive it. For example, if the parent paid $500,000 for an 80% interest, stop right there. 80%. We've got control. That means we got to consolidate. 1 minus 0.80, 20%. That is my non-controlling interest. Okay, now fair market value per share, not given. So how do we find the implied fair value for a 100% stake in this company? You ready? The parent paid $500,000 equals 80% of the total value. Divide both sides by 80%. What must be the total value of this company? $625,000 must be 100% of the fair market value. That's got to be 100%. If you paid $500,000 for 80%, then 625 has got to be the 100% of the fair market value. Okay. Now, what percent don't we own? 625,000 times 1 minus the percent we bought, 20% of $625,000. $125,000, that is the initial carrying value of the non-controlling interest. 500,000 is our initial carrying value for the investment in subsidiary. It's that simple. All right. Both of these will be adjusted over time using the equity method of accounting. Both of those initial carrying values are adjusted over time. Both initial carrying values are adjusted over time using what method? using the equity method to go from your beginning to your ending carrying value, picking up your share of the net income, your share of any excess depreciation. Okay, so the initial carrying value for the non-controlling interest, 125. They're going to pick up their 20% share of any profit or loss, their 20% share of any dividends. Okay, that would be the ending non-controlling interest. Whatever that number is the ending NCI. That is part of consolidated equity. What is consolidated equity again? It is the parent standalone equity plus the ending carrying value of any non-controlling interest. That's it. So NCI. All right, consolidated equity equals the parent plus the non-controlling. All righty, so remember, when you consolidate, even though we only own, 80%, what percentage of the liabilities and assets are being acquired? Are being combined? 100% of the sub's fair value of their assets and liabilities. Okay, in a consolidation, non-controlling interest is credited. It is included. How do you include equity with a credit? EAGLIN, with that credit to non-controlling interest, we've now included that. Okay, consolidated income statement, we're going to combine 100% of parent and sub revenues, expenses, gains and losses, even though we only own 80% in this example. The sub's net income times the subsidiary's percentage share, 20%, the net income attributable to the non-controlling interest, this will be subtracted when arriving at consolidated net income. Parent standalone net income using equity method to account for that investment in the sub is going to equal consolidated net income. So why bother? Because now we have much greater disclosure. Rather than that single line item, equity earnings and subsidiary, hell no. Now what do we see? Oh yeah, now we see parent and subsidiaries, revenues, expenses, gains, and losses. So we can determine or try to determine sustainability, what's driving it. All right, so here's an excellent example. Pancake Company acquired 90% of syrup. Stop right there. As soon as you see the 90%, what do you think? Control, I got to consolidate. Parent alone, use the equity method. What's my non-controlling interest? 10%. Do I need algebra? Or did they give me the fair market value of the stock? Let's see. The first thing I'm looking for is, did they give me the fair value? Yup. Fair value, $8 per share. At the date of acquisition, syrup has 100 shares outstanding, right? Stop right there. The fair market value of the non-controlling interest, that 10% share. The sub has 100 shares issued and outstanding times a fair market value of $8 per share. So the total fair value of the sub, 100 times 8, 800. So non-controlling interest is 10%, 10% of 800, non-controlling interest, 80. There we go. Part of consolidated equity. All righty. Now, what was our purchase price? Our purchase price for that 90% stake, 900. Okay. The non-controlling interest is 10%. What's the fair value of that 10%? 80. What's the total fair value then for 100%? 980. Less fair market value of identifiable equity. Let's see. Here's the book value of the sub's equity. The book value of their equity, 100, 100, 400. The book value of their equity, 600. Now let's see, is there any excess of fair value over book value? Equipment with a remaining life of 5 years. Fair value $100 higher than carrying value. So an asset has a fair value greater than book value. So the fair market value for that identifiable equity is 700. Okay, 700. Pop that 700 in there. Well, you didn't pay 700. What the hell's going on? I don't know, but I can't call it I don't know. So I'm going to call it Goodwill instead. 980 minus 700, Goodwill is 280. Now that equipment had a useful life of 5 years, 100 divided by 5 years. What's my excess depreciation each and every year? 20, but now that's got to be allocated. 90% to the parent, 10% to the sub. Got it? I know you do. I know you do. All right, here we go. Initial consolidation. You ready? How do I do my initial consolidation? My initial consolidation. Let's do it. Eagles in, baby. Book value of the sub's equity, put it in the car. What we say that was, the book value of their equity. So I look it up, I look it up, I look it up. 700. Let's get rid of it. So my initial consolidation, points on the exam, 700. Common stock, additional paid-in capital, retained earnings. Assets, fair value over book value. There's no excess depreciation because it's our initial consolidation. That was 100. Goodwill, what did we say the goodwill was? 280. Liabilities, any fair value over book value? 0. By the way, if the book value is ever higher than the fair value, then you'd have to reduce the liability. Okay, I'm assuming that it's greater. Investment in subsidiary. Investment in subsidiary. What did we say our investment in subsidiary was? We debit. Investment in sub, what did we pay? 900. Credit cash, 900. So investment in subsidiary, 900. Got to get rid of it. And now, non-controlling interest for the first time. We own 90%. Somebody owns the other 10%. 80. Now, my credits add up to 980. I wrote the 8 before the 9. Something is seriously wrong with me. All righty. So we've got, and that should be 280, 180. Investment in subsidiary, 900. EAG assets. Let's see. So the car book value I'm sorry, folks. The book value was not 700. You see, you double check 600. The book value of the equity. Book value, Peter. Book value of the equity, 600, bro. What you doing? 600. Come on, man. 600. 600 plus 1, 700, 980. That's why you always double check. Do my debits equal my credits? Yes, they do. It's a good way to check yourself. See if you made a boo-boo. Okay, the fair value of the equity is 700. The book value of the equity, book value, 600. All right, so there's our initial consolidation. No activity yet. Our worksheet, don't forget, Goodwill, the only place we're going to see it, consolidated balance sheet. Non-controlling interest, the only place we're going to see it, consolidated equity. Check yourself. What's your consolidated assets? My consolidated assets add up to what? 9,080 minus my consolidated liabilities, 0. Consolidated equity, 9,080. Okay, here's your consolidated equity, 9,080. Consolidated assets, 8,000. Who's messing with me? 8,600, 88. Come on, man. Got the wrong number in there. Let's go. You forgot the car. So there's our C. So our consolidated equity. Let's see. 8,600 plus, let me just double check my math. I'm building your confidence right now. You're like, how this dumbass pass the exam? Homeboy can't even add. 8,600, 200, 280. There we go, 9,080. Consolidated assets, 9,080. All righty. consolidated assets minus consolidated liabilities, add up your consolidated equity, you get 9,080, and that should equal, we're praying, the parent alone equity, parent equity added up 9,000 plus the non-controlling interest 80. What's consolidated equity? Yep, it all checks out, 9,080. Okay, so all you got to do is be able to fill in on your worksheet. When you buy this company, investment in subsidiary, is that investing, operating, or financing? So long as it's a non-current asset on your statement of cash flow, that would be an investing. That cash paid, the cash paid. Investing outflow. Remember, when you buy or sell trading securities held for trading, okay, that's an operating outflow. So when you buy or sell trading security, also known as held for trading, also known as fair value through P&L, when you buy it outflow, when you sell it inflow, that's operating. But any other type of investment, preferred equity, equity method, held to maturity, amortized cost, fair value through OCI, available for sale under US GAAP. The only thing that can be classified as available for sale is debt. Any other type of investment is investing outflow when you buy it, investing inflow when you sell it. Okay, so here's our EAGLIN again, book value of equity. There's our E, there's our A, there's our G, liabilities, 0, IN, 980, just, oh, and I wrote the 8 again before the 9. What the hell's going on? Okay. Put the book value of the subs equity in the car. Debits add up to 980. Fair value over book value. Over time, that will be net of excess depreciation. Goodwill might be net of impairment, but not quite yet. Okay, intercompany transactions. You ready? Let's do some intercompany transactions. We've got to do the EAGLIN elimination entry, the EAGLIN elimination entry, and we have to eliminate any intercompany transactions. Maybe we have sale of services. Maybe we have sale of inventory. Maybe we have sale of PP&E. Okay. Maybe we have one company lending, the other company borrowing. Intercompany sale of bonds. So these are the 4 transactions that you may see that have to be eliminated in addition to the EAGLIN is in. Okay, so any intercompany transactions have to be eliminated. Okay, so all intercompany transactions, you can't sell to yourself, you can't lend to yourself, all that kind of good stuff. Okay, so what is the objective of doing this? Remove any evidence from the consolidated financial statements that we've lent money from one company to the other. One company's payable is the other company's receivable. Let's get rid of that. Any intercompany revenue and expense. Oh, you performed a service for me. I'm going to debit service expense. The other company's crediting revenue. Well, we got to get rid of that. One company's revenue, that gets eliminated. That is the other company's expense. That gets eliminated. Okay, so we got to get rid of any intercompany transaction. So we give an example. Company S owed Company P $10,000 for services on the consolidated balance sheet. What do we got to do? Debit that payable, $10,000. Credit that receivable, $10,000. For the consolidated income statement, one side's revenue, $10,000, is the other side's expense, $10,000, and that should be a credit. Okay, so it's easy. When it's an intercompany sale of services, get rid of the payable and the receivable, get rid of the revenue and the expense. All right. So consolidated balance sheet, one company's liability goes down, the other company's asset goes down. Okay, it's called a zero-sum game. All right, one side's payable, one side's liability has got to equal the other side's receivable. Okay, intercompany dividends have to be allocated. Okay, how much of that is going to the parent? How much of that is going to the non-controlling interest? So we just want to keep track of the percentages. Okay, intercompany during the period, S, the subsidiary declared $15,000 in dividends to the parent. At the end of the period, the dividends have not yet been paid. So we have a payable, we have a receivable. So consolidated balance sheet, what do? Debit, payable, get rid of that liability, $15,000. Credit, that dividend receivable, get rid of that asset, $15,000. Okay. Under equity method, remember, dividends not income. They reduce the investment in subsidiary and ending carrying value of the non-controlling interest. So nothing to eliminate on the consolidated income statement, okay, because dividends are not income. We eliminate EAGLIN. Dividends affect the carrying value of the investment in the subsidiary as well as the non-controlling interest. It affects the consolidated balance sheet because it affects the carrying value of the investment account and non-controlling interest. Since it's not income, there's nothing to eliminate in terms of the consolidated income statement. Okay. Now, dividend receivable. So when the receivable is declared, we're going to have a debit to dividends receivable, credit to investment in subsidiary. The carrying value goes down. This is not income. It reduces the carrying value. Okay, subsidiary with debit retained earnings, credit dividends payable. Their equity goes down, their liabilities go up. No change to their assets. So this dividend receivable and this dividend payable need to go away. How do we get rid of a liability with a debit? How do we get rid of an asset with a credit? To consolidate the balance sheet. So this would be to consolidate the balance sheet only for the payable and the receivable. Okay, the investment in subsidiary account would be adjusted. All right, do not forget, dividends payable to non-controlling interest shareholders are not eliminated. Why? They are outsiders. Okay, so when you prepare a consolidated balance sheet, dividends payable to the non-controlling interests are not eliminated. Why not? Because they are outsiders. Okay, because they are outsiders. Okay, so that dividends payable is not getting eliminated because they are outsiders. All righty, intercompany sale of inventory. You ready? You are going to eliminate sales, the cost of goods sold, and any intercompany profit not yet realized by selling to outsiders. Okay, you are going to debit sales, you're going to credit inventory for the intercompany profit we want to eliminate. And then you're going to credit cost of goods sold. That'll be your plug figure. Now, this could be done in one journal entry or two. This is the one journal entry approach. I like this because there's only one. Or you could do a two journal entry approach. Debit sales, credit cost of goods sold for the entire transaction. Okay. Debit your sales, credit your cost of goods sold for 100% of the transaction. Then debit cost of goods sold, credit inventory for the intercompany profit. That's got to be eliminated. I only show you just in case there's ever an example where they give you two journal entries. It's not a problem because the net change, the cost of goods sold, the net change, the cost of goods sold is going to be exactly the same, whether you do it in one or two journal entries, okay? All right, so the effects on the financial statements. Ready? Debit sales for 100% of that transaction. Credit cost of goods sold, that's your plug figure, the net amount. Credit inventory for the profit you want to eliminate. If there's any account payable or account receivable, get rid of it. One side who owes money, get rid of that payable. One side who's supposed to get the money, get rid of that asset. Okay, if there's any money that's owed between the parties as a result of that transaction. The credit to inventory is for the amount of intercompany profit. So Pete, how do we calculate that intercompany profit? I'm so glad you asked. Remember, when you see a sale of inventory from parent to sub or sub to parent, we credit inventory for intercompany profit that has got to be eliminated. All right. Panther purchases inventory from an outside supplier for $8,000. All right, so Panther, I'm going to assume is my parent. Their cost for the inventory is $8,000. Panther then sells the inventory to Shark, one of their subsidiaries, for $12,000. So Panther, the parent, they've got a selling price of $12,000. They have a cost of goods sold of $8,000. What's the profit on this intercompany sale? $4,000. Okay, now I need to see, did the subsidiary flip any of that inventory to an outsider? Well, they tell me Shark does not sell any of the inventory to an outsider. Thus, 100% of intercompany profit has to be eliminated. All right, so let's just deal with that. 100% of the intercompany profit has to be eliminated. So what am I going to do? I'm going to debit sales, $12,000. I'm going to credit my inventory for the amount of intercompany profit that has to be eliminated, all of it. And then I'm going to credit cost of goods sold. This is my plug figure, $8,000. To make my journal entry balance, that is my quote unquote plug figure. Or if you want to do the two journal entry approach, debit sales, $12,000. Credit cost of goods sold, $12,000. Then debit cost of goods sold, $4,000. Credit inventory, $4,000 for the intercompany profit that's got to be eliminated. Okay, you credit inventory for the intercompany profit that needs to be eliminated. And obviously, if there's any account payable or accounts receivable, if the bill hadn't been paid yet, debit accounts payable, $12,000. Credit the other side's receivable, $12,000. If the sale were on credit, okay, it doesn't say whether or not it was on credit, but if it were sold on credit, we'd have to get rid of any payable or receivable. Okay, what if the subsidiary sells half of the inventory, finish the sentence, to outsiders? Then 50% of $4,000 profit has to be eliminated. So if you want to do the one journal entry approach, debit sales, $12,000, credit inventory, $4,000 times 0.5, $2,000, credit cost of goods sold for the balance, $10,000, one journal entry approach. Or if you want to do a two journal entry approach, Debit sales, 12,000. Credit cost of goods sold, 12,000. Debit cost of goods sold for the intercompany profit that has to be eliminated, 2,000. Credit inventory for the intercompany profit that has to be eliminated, 2,000. Either way, the net change to cost of goods sold is the same. The net change to cost of goods sold is exactly the same. We reduced it by 12, then we increased it by 2. Thus, the net change to cost of goods sold, either way, is a reduction of $10,000. Okay, that is an intercompany sale of profit. An intercompany sale of inventory with the elimination of the profit. All right, so intercompany sale of PP&E. How do we do it? Intercompany sale of PP&E. Step 1, selling price minus net book value. There's your gain or loss. How do you get net book value at time of sale? Original cost minus accumulated depreciation. Okay? Original cost minus accumulated depreciation. All right? Step 2. Reinstate accumulated depreciation. Eliminate a gain or loss. Plug PP&E to balance that journal entry. You got to reinstate your accumulated depreciation. You got to eliminate that gain or loss, and then you got to plug your PP&E to balance. Pete, how do we do it? All right, don't forget. First thing you got to do is eliminate the gain on sale or loss on sale. How do you reverse a loss? To reverse a loss, you credit. To reverse a gain, you do that with a debit. Okay. You've got to reinstate accumulated depreciation. Reinstate the original accumulated depreciation. Accumulated depreciation is what kind of an account? A contra asset. How do you get a contra asset back on the books? You debit. You credit your accumulated depreciation. I'm losing it, baby. I'm losing it. Okay. You're going to plug PP&E to balance that account. Okay. 2, eliminate additional depreciation resulting from the markup of the asset. Reduce depreciation expense back to seller's amount. Okay. You're going to debit accumulated depreciation. You're going to credit depreciation expense to reduce it back to its original amount. All right, let's see what we got. How do we do it? Ready? Parent sells equipment with a $500 cost and $200 accumulated depreciation. Stop right there. Information overload. Cost, 500, minus accumulated depreciation, 200. Net book value, 300. We have to reinstate that accumulated depreciation as you're going to save. Selling price, 450. Stop right there. Selling price, 450, less net book value, 300. Gain on sale, 150. We got to eliminate that gain. Okay. Now, let's do our journal entries from the perspective of the parent and the sub, not the elimination, but the parent and the subsidiary. You ready? So we sold. Parent sold for 450, selling price. Investing inflow. When you sell a non-current asset, investing inflow. Debit cash, 450. How do we get rid of accumulated depreciation? A contra asset has a credit balance. So how do we get rid of that? With a debit. Accumulated depreciation, 200. We got to get rid of the original cost, 500. Then we plug our gain. What's our gain? 150. What's the subs journal entry? Debit PP&E. What did they pay for it? 450. How did they pay for it? Cash or debt, whatever. Investing outflow, 450. Okay, what was the parent's depreciation? What was the parent's depreciation? Ready? They say the asset has an estimated remaining useful life of 5 years. The parent depreciation would be the remaining net book value. The remaining net book value, 500 minus 200, remaining net book value, 300, divided by the remaining useful life. Remaining useful life, 5 years. 300 divided by 5. What would be the parent's depreciation? 60. Okay. What is the subs depreciation? Their cost divided by remaining useful life. Their cost divided by remaining useful life. What was their cost? They paid 450. What's the remaining useful life? 5 years. Depreciation 90. What's the difference? What's the change in depreciation? A plus 30. Okay. Now, what is my journal entry? To eliminate that intercompany sale of PP&E. What is my journal entry? To eliminate that intercompany sale of PP&E. First thing we got to do is get rid of that gain. How do you get rid of a gain? With a debit. 150. We got to reinstate that 200 of accumulated depreciation because it's as if the sale never happened. How do we reinstate accumulated depreciation, a contra asset, with a credit? So what do we plug to make this journal entry balance? You plug your PP&E. That is your plug figure. We have to debit PP&E by how much? 50. That's your plug figure. Now, logically, why are we debiting PP&E for 50? Why debit PP&E 50? Why? What's your reconciliation? Because the seller's cost was 500, and I don't want to do that too close to that journal entry. So why debit PP&E for 50? Why debit PP&E for 50? Parent cost 500, subsidiaries cost only 450. So the change in cost is a reduction of 50. We got to get that PP&E back to its original cost. How do we get it back to its original cost? Debiting it for 50. All right. So that's how we deal with a sale, intercompany sale of PP&E. All right. We'll do another one. Intercompany sale of bonds. You can't owe money to yourself. All right. One side's investment in bond an asset is the other side's obligation, liability. Okay, so again, it's a zero-sum game. One side's investment in bond and asset is the other side's obligation, liability. All right. So what's going to be our journal entry? Well, to get rid of that investment in bonds, to get rid of it, to eliminate, what are we going to do? Treat as if bonds were retired. If the investment in bond is less than the carrying value of the liability, that's going to be a gain on retirement, and vice versa. If the investment in bonds is less than the carrying value of liability, that's going to be a gain on retirement. Okay, now, before we do anything else, you ready? Face value of the bond minus any unrecorded, unamortized discount. That's how you get the carrying value of the liability. Okay, the face value of the bond plus any yet to be recorded premium. We got a whole class devoted to bonds, okay, that explains discount and a premium. That's how you get the carrying value of the liability. If the bond is issued at a premium, the carrying value of the liability is going to be greater than or equal to the face value. Eventually, it'll be the same as we amortize the premium by making interest expense less than the coupon paid, as you're going to see in the bond class. Okay, when the bond is issued at a discount, that's a loss. That'll make your interest expense greater than the coupon paid. As we amortize the discount and subtract a smaller and smaller amount, the carrying value liability is going to go up. Okay, less than or equal to, when will they eventually be equal? At maturity. Then the carrying value equals the face value. As you amortize the premium and add a smaller and smaller amount, the carrying value of the liability is pulled down until eventually it's the face value. Okay, let's take a look at an example. You ready? They tell us South Dakota issued, and what I do here, 8% bonds. 8% bonds. You ready? To external parties at their $100,000 face value. So that means no discount or premium. That means the carrying value of the liability is going to equal the face value of $1,000. Okay. On December 31st, the parent company, Pennsylvania, purchased all of the bonds outstanding for $900 plus accrued interest. Okay, so the investment in bonds, so the parent company's separate journal entry, they're going to debit investment in bond. How much is the investment in bond? $900 plus accrued interest. Now look, when bonds are sold between interest payment dates, this bond was sold on December 31st, year 5, but the interest is not going to be paid until January 1 of the next year. That accrued interest will be paid by the buyer of the bond to the seller of the bond, because the buyer of the bond the next day is going to get an $80 coupon that they didn't earn. That was earned by the seller of the bond, okay? So that's accrued interest. So part of the payment for the bond, they're going to credit cash, $900 for the bond plus $80 of interest. Where did we get that from? The face value, 1,000 times the coupon rate. Whenever the bond is issued at face value, the coupon rate equals the market rate. Interest expense and interest coupon coupon paid are one and the same, 80. So they're going to pay $980 to the seller of the bond. $900 is for the cost of the bond. The other $80, that's going to be interest receivable. Interest receivable. They're going to get that in a day, but they didn't earn that. The seller earned that. So the buyer of the bond pays $900 for the bond and tells the seller, hey, I'm getting the check tomorrow for $80, but you earned that this whole year. That's yours. So they pay $980, $900 for the bond, $80 for the interest. They're going to get that interest tomorrow, though, okay, when that dividend gets declared. So that's, when that interest gets paid. All righty. Now, the subsidiary, the borrower, remember, we're accrual basis, not cash basis. On December 31st, they got to record interest expense, even though they're not paying it until the next year. They got to record. They're going to debit interest expense, 80. They're going to credit interest payable, 80. That interest expense doesn't get eliminated. Why? Because that belongs to outsiders. The seller of the bond, who's an external party, they earn that 80. So that doesn't get eliminated. What's going to get eliminated is that interest receivable and that interest payable. Okay? So now, how do we eliminate? You ready? It's as if we retired the bond. So we're going to debit the bond payable. Carrying value of the liability is going to go away. There's no discount, no premium. 1,000. The gain on retirement. Now, how do we get the gain on retirement? It's the difference between the carrying value of the liability and the carrying value of the asset. The investment account is for how much? 900. We got to get rid of that. What's your plug figure? The gain on retirement, 100. All righty. So that liability had a carrying value of 1,000. We get rid of that with a debit. We get rid of the parent company's investment in that subsidiary's bond, their purchase price, that gets rid of the asset. And then the gain on retirement, that goes away. All righty. That's our plug, or excuse me, that gets recorded. That's our plug figure. Okay. And that gets recorded. It's as if we retired it. Now, either net income is going to go up, or if the income statement accounts have already been closed, then retained earnings goes up, whatever the case may be. But that's only journal entry 1 of 2. What's the second one? We got to get rid of the payable. That liability goes away. We get rid of that receivable. That asset goes away. Zero sum gain. One side's asset is the other side's liability. One company's receivables, the other company's payable. When you buy a subsidiary's bond, treat it as if the bond were retired. What's the carrying value of the liability we got to get rid of? 1,000. It's as if we retired it, and yet we purchased it. We got rid of $1,000 liability. We got rid of $1,000 liability by only reducing assets by 900. Liabilities have to, assets have to equal liabilities plus equity. Well, if your assets are down by 900, but your liabilities are down by 1,000, how do we make this balance? Retained earnings has got to go up by 100, such that the net change to the capital side of the balance sheet is down by 900. You don't have to memorize. Okay, you could do your balance sheet. You get it. All right. Now look, the way the UWorld product works is, folks, we lecture, all of these are different subtopics, okay? So we break it down. When you see these blue screens, we break it down by subtopic. We do an example, then you would do multiple choice on your own. Then we do the next subtopic. We do an example together, then you do multiple choice on your own. Then at the end of the lecture, if it lends itself well to a task-based simulation, we're going to do a practice scenario together. In addition, Megan is going to be making you 100% comfortable with task-based simulations, because there's a whole video series of how to break down that information. Okay, how do we go through a task-based simulation? You never start with the facts or open an exhibit. Hell no, start with the requirements. Legalize cheating. That's going to tell you what to do with those facts. You'll write down your formulas, whatever you got, then you'll read the facts in context. But it's really important you have a whole video series just devoted, because look, the FAR and BAR pass rates are low. Not so much because of poor performance in multiple choice, although that does happen. It's mostly the inability to translate that information from multiple choice to task-based simulations, okay? So we got that whole video series. Then we have live online lectures, just like you're seeing here, where we go through the content, but mostly today I wanted to show you what our textbooks look like. Okay, so that's why I did all this stuff. I wanted you to see what our textbook looks like. You know, this is what it looks like digitally and in print. By the way, we don't charge you for the print copy because we want you to put the pen to the paper, make notes while we do it. But the live online lectures are then designed to say, hey, Pete, give me the hardest multiple choice, give me tough task-based simulations, and let's do those together. Okay, and that's all part of the course. All right, so here's a practice scenario. Okay, so we're going to tell you, hey, you know, what does the AICPA want you to do? What do they say about this stuff? Well, they're going to tell you, hey, you've got to be able to do the representative task, application. There's different skill levels, right? Remembering and understanding, that's one. And then maybe you have to apply it. Maybe you got to analyze it, or an audit. Maybe you got to evaluate something, right? Fairly stated, not whatever it may be. So we're going to show you exactly what's in the AICPA guidelines. Okay, that's going to tell us the skill level. All right, so let's bang it out. We're almost done. Hang in there. Look, I know it's time, sort of, kind of, but look, we got serious shit to do here. So we're almost there. Let's bang it out. And let's do it together. All right, I acquired 85% of another company. As soon as I see that, I think control. I've got, and by the way, I'm not even following my own rules. You ready? Example of a TBS. So what they want me to do, I go to my requirements. I see all these exhibits. What the hell do they want me to do with this? So examine the consolidation worksheet, identify discrepancies between the worksheet information, what is there versus what should be there, okay? So mostly I want to focus in on the application of the rules. I don't care what was exactly asked. I want to do everything that, you know, we could with this, all right? But obviously we'll answer this TBS as well. I just want to make sure we're applying everything. So we got control, we're going to consolidate. As soon as I see that on the exam, I'm thinking, okay, we own 85%. Therefore, the non-controlling interest is 15%. I'm thinking EAGLIN, put the book value of the sub's equity in the car. And he asked it over fair value, goodwill, liabilities, that right. So this is what I'm thinking wrong before I look at exhibits and all that stuff. So we've got to prepare. Poppy is preparing consolidated financial statements for the year ended. So we got to adjust, okay, adjust. So let's see. When did we acquire them? December 31st, year one. When are we preparing the consolidation? December 30, oh, the exact same day. So we're actually consolidating on the date of acquisition. So there's no equity earnings, right? There's nothing to worry about. No dividends. The carrying value of the investment in the subsidiary, carrying value of investment in subsidiary, and the non-controlling interest. Use beginning balances. Date of acquisition. Now, obviously, there are other task-based simulations where we'll do beyond the date of acquisition. Here, again, you got to walk before you run before you fly. All right, so that's what we're doing here. Okay, so now here's my worksheet. All right, are there any mistakes? Here's exhibit one. Did they screw anything up? Okay, so here are the EAGLIN adjustments. Did they screw anything up? Well, let's see. Let me go through book value of the equity. Where's subsidiaries equity? All right, here's their common stock, additional paid in capital, retained earnings. All right. Oops, I got long-term debt in there. Sorry about that. We got common stock and retained earnings. All right, so we got to eliminate that. There's the E in EAGLIN. Any asset. Fair value over book value. Well, let's see. 70,000. Fair value over book value. Well, that would be the A. Is that correct? I don't know. Investment in sunflower. There's my I. Is that correct? I don't know. Goodwill. There's my G. Is that correct? I don't know. Liabilities. 150 and 110. We got current and non-current. Are those amounts correct? The L. I don't know. We got the investment in subsidiaries, so we got the E, the A, the G, the L. I don't know about the liabilities. The investment in subsidiary account is 325, right? I don't know. Not where the hell is the non-controlling interest? They forgot that. Where's the 15% non-controlling interest? That should be part of. That should be part of consolidated equity. So we know they screwed that up for sure. Okay, so I got a feel for what's going on here now. Okay. So we got to check ourselves. So now I will see what else we got. Here we go. On December 31st, year one, Poppy acquired, we know 85%. Sunflower for $325,000. Stop right there. My purchase price for that 85% interest was how much? $325,000. Now I need the fair value of the non-controlling interest, 15%. Do I need to do algebra, or did they give me a price per share? So that's immediately what I'm looking for. They tell me sunflower at 100,000 shares outstanding at a price of $350 per share. Stop right there. You ready? So they just gave me that. So the sub has 100,000 shares. Key is issued and still outstanding. If it's held in treasury, we ignore it. I want the shares that are outstanding. Times fair market value, 350. Fair market value per share, 350. So what's the total fair value? Total fair value, $350,000. Now, what is the non-controlling interest? Times the non-controlling interest, 15%. So what is the fair value of the non-controlling interest? I got that to be $52,500. Fair value of the non-controlling interest, $52,500. Okay, add that together. What's the total fair value, therefore, for a 100% stake in this company? 325 plus 52, $377,500. Okay, now less the fair market value of the identifiable equity. I don't know that number yet, but that'll get me my goodwill. Okay, that will get me my goodwill. But the first thing I know is the non-controlling interest should be on the books on the date of consolidation at $52,500. $52,500. It is the non-controlling, it's not there. We got to insert it. So I go back to my worksheet. Is the adjustment in the worksheet correct? No. What is the amount that should be there for the non-controlling interest? $52,500. Should it be a debit or a credit? Let's see. EAGLIN, credit. There we go. One down, lots to go. We're kicking ass, baby. Do you feel it? Are you thinking about all that money you're going to get after you pass the exam within the first year of employment and get that big fat ass bonus? Come on, man. Drinks are on you, but I'll buy you the coffee. All right, let's see what else we got. Here's their balance sheet. Now remember, balance sheet, this is always book value. So here are their assets, book value. Book value of the assets minus the book value of the liabilities. There's the book value of the stockholders' equity. Okay, there's the book value of the equity, $200,000. Now I need to see, is there any difference between fair value and book value? Well, let's see. I received updates on the date of its acquisition. The fair value of the machinery was determined to be $150,000. Stop right there. All other assets and liabilities, fair value equals fair market value. So stop right there. All righty, the machinery is on the books. The book value of the asset is 80, yet the fair market value, man, short-term memory sucks. What they say the fair value was? The fair value was $150,000. So that's a plus $70,000. So the book value of the equity is $200,000. Okay, how do we get the fair market value of the equity? We take the fair market value of the identifiable assets, 460 plus 70, 460 plus 70, 530. Minus the fair market value of the identifiable liabilities. They said the assets and the liabilities were one and the same, 260. Book value equals fair value, 260. So the fair market value of the identifiable equity is how much? 270,000. Or you could take the book value of the equity plus the change in the fair market value of the assets, 70, same result, different format. There's the fair market value of the identifiable equity. All right, 270. I go back, $270,000. I pop that in. Okay, so there is the fair market value of my identifiable equity, $270,000. So I take my purchase price, $325, plus the non-controlling interest, $525, get $377,500. Minus fair market value, the identifiable equity, $270,000. We got goodwill, $107,500. Now, because I cheated, I know that's one of the things I got to look at. Did they get that right or wrong? What do they have the goodwill at? $55,000. That is wrong. So they screwed that up. Goodwill, is the amount correct? No. What should it be? $107,500. How do we get that? A debit. We debit the goodwill. You see your EAGLIN, you got your little cheat sheet there. Tell you right away whether it's a debit or a credit. Okay, inventory. Inventory, let's see, any adjustments for inventory? Nah, the inventory, everything else, fair value, book value was fine, right? Just the PP&E we needed to adjust. Okay, so let's see, no adjustments to inventory yet. Machinery, did they get that correct? Yeah, they added 70,000. Okay, so that looks correct. So I think they did that correct. So is the adjustment? Yes. What is the amount of the worksheet in the adjustments column? Well, we don't need to do that. What amount in the worksheet should be reported? Not applicable? Not applicable, already done. Correctly done. Okay, so And if we had to pop in a number, let's see. So 70,000 in the adjustment, and that should be a debit. Get the fair value. There's your asset fair value over book value. Okay, common stock, retained earnings. Let's see, common stock, retained earnings. We got to get rid of the parent, the subsidiary's common stock. Did they get rid of the common stock? Yes, they did. Okay, they got rid of the common stock, 140,000. So is that done correct? Yes. So 140,000 is the right amount. Debit or credit? Let's see. So that is how to get rid of a credit with a debit. So that was all done correct. We're good. Okay, retained earnings. Well, let's just see. There's something with inventory. Let's see if anything else went on. We got that. We got that. Additionally, check this out. How weird is this? On the date of acquisition. You see how they're messing with you? Even though it was the date of acquisition, it actually was an intercompany transaction. That's why you got to make sure you go through all the facts. We got an intercompany sale of inventory. Stop right there. When I see an intercompany sale of inventory, I like the one journal entry. I'm going to debit sales for whatever the selling price is. Okay. I'm going to credit inventory for the profit that has to be de-recognized. Okay. And then my plug figure, that'll be my credit to cost of goods sold. That's my plug figure. So let's see what we got. They tell us on the date of acquisition, we sold inventory to Sunflower for $14,000 at a profit margin of 40%. Stop right there. Selling price, $14,000. Cost of goods sold, profit. The profit is what? 40%. That means the cost of goods sold has got to be what? 60%. Okay, it's got to be 60%. So cost of goods sold, what's 60% of $14,000? $8,400. What is the intercompany profit? $5,600. Now, how much of that has to be eliminated? It all depends. What percent was sold to outsiders? They have not sold any of this inventory yet. Thus, 100% of intercompany profit has to be eliminated. Now let's pretend they sold 20% to outsiders. Then 80% would have to be eliminated. What if they sold 25% of that then to outsiders? 1 minus 25, then 75% of the intercompany profit would have to be eliminated. But since none of it was sold to outsiders, 100% of that intercompany profit's got to be de-recognized, $5,600. Okay. We're going to debit sales, $14,000. We're going to credit cost of goods sold. That's my plug figure, $8,400. Or if you wanted to do two journal entries, debit sales, $14,000. Credit cost of goods sold, $14,000. Debit cost of goods sold, $5,600. Credit inventory, $5,600. Credit inventory, $5,600. Okay. So any way you slice it, cost of goods sold is going to be reduced by how much? $8,400. Decrease it by 14, then increase it by 5,600, a net reduction of 8,400. All righty, so folks, they screwed something up here, didn't they? Let's see that worksheet. I saw nothing done to that inventory at all. Folks, they needed to do what with that inventory? They needed to credit that inventory, $5,600. They need to debit something, sales, credit cost of goods sold. Again, I'm doing the net amounts. Credit inventory, $5,600, $8,400. Now, the profit, oh, sugar, what the hell did I do? I'm sorry, folks, what did I do? Holy crap. Did you guys just cut me off? Are you people, what are you guys doing? Hello?
It's not me, Pete. It's not me.
UWorld.
We can still see your screen, but we can see all the slides.
Oh, you can? All right, you're messing with me, man. I'm old. At my age, we want to be a heart attack.
You're just not on full screen mode anymore.
There you go. We'll forgive you for blaming us, Pete.
All right. So there's no consolidated income statement. So we need to reduce inventory. They screwed up inventory. All right, we got to reduce inventory by $5,600. So inventory, no, they screwed it up. $5,600 adjustment, and that's a credit to inventory, Okay, they screwed that up. Now the question is retained earnings, folks. Now we don't have a consolidated income statement. Sales and cost of goods sold this is the key, and then I'll let you guys go. Sales, $14,000. Cost of goods sold, $8,400. These accounts have already been closed. Profit of $5,600 made retained earnings go in what direction? Up. Sales and cost of goods sold have already been closed out. Okay, so we've got to reduce retained earnings. We've got to reduce retained earnings by $5,600. How do you reduce retained earnings? With a debit. And what did we credit? Inventory. So folks, we credited inventory $5,600. Retained earnings is wrong. It's wrong. We got to reduce inventory by another $5,600. We don't have sales and cost of goods sold. Those accounts have been closed out to retained earnings. That profit made retained earnings go up. So we got to make retained earnings go down. Damn it. I'm all pissed off now. I'm all like cranky and shit. So where's my slide? Okay, so now we got to reduce retained earnings. So let's reduce come on, man, my computer's frozen. Let's go. We'll freeze on me, hold on. So you guys mess with me, man, and mess with old people. Shit ain't right. All right, $5,600. So now let's go back to our worksheet, fix that. 56, where's my worksheet? There we go. Retained earnings, is that correct? No, it is not. We got to reduce that retained earnings. And how much did we reduce it by? $5,600. Okay, so the answer to retained earnings, no, that is not correct. No. What is the amount? $5,600. And how do we reduce retained earnings? If you want to reduce retained earnings, how do we do it? With a debit. Now I'm done, UWorld people. Rushing me and shit. Damn salespeople, you don't like no accounting. Why not? I'll tell you why not. You know what happens? If you can't hack accounting, you switch to finance. If you can't hack finance, you switch to management. If you can't hack, I'm just messing. Oh my God, I need a break. All right, I feel like I just gave birth to an expert in consolidations. What do we got? What do we got? All right, now let me turn it over to you guys. Get rid of me. How do I stop sharing?
Wait, Pete, before you go, people had really important questions for you.
Yeah.
They did.
Oh, wait. I thought we wanted to do SHAR first. SHAR first. No?
You the important questions, which is.
All right, go ahead.
Yeah, somebody wants to know why you're an multiple people want to know why you're an active instead of an active CPA. Why
I'm inactive? Because I stopped doing audit in 1992 or something like that. I don't plan on signing off on any audit reports anytime soon. Are you out of your mind? Plus, I got to do continuing ed for the bar and this and that. Everybody's got their hands in my pocket. And I'm like, no, I don't practice anymore. And I don't plan on practicing. So I am inactive because I don't do that anymore. I'm also, and they didn't have retired status. I think I'm old enough now. Actually, I should change inactive to retired. So I had filed for inactive status because I was too young to retire, according to those folks. So, oh, and by the way, I just want to point out, folks, the retained earnings, I'm over here talking, fooling around. The retained earnings should have been an adjustment of $5,600. So the elimination, so do me a favor, in that column C with the retained earnings, the adjustment is $5,600. We had 60,000. It should be 65,600. So I rushed off, but the amount that should be in the worksheet is not a debit to retained earnings for 60 plus 5,600 I just put in the 5,600, I do believe. It should be 65,600, okay, with the debit. So I think it was I can't write anymore. But 60,000 plus 5,600, 65,600. What was that, a Becker plant? Who's logging on from that other company? Get out of here. Do me a favor, Becker people, don't worry about my lectures and my activity. Why don't you take me off your videos? I know why. 3 years later, and the client and the world knows why. Because ain't no replacing no CPA, man. Because if you could have, you would have, and you should have, but you didn't. So stop planting yourself in my videos, huh? Go get yourself somebody else to do your FAR videos. Get out of here. Shit.
Also, Pete, later, I'm going to send you somebody left us a rap for you. So I'm going to send you the lines, and I'm told you can save it for later and use it if you'd like. So I'm going to get that sent over to you. Don't worry, I saved it. And now
you got it, baby. You got it.
That was the important part.
You go.
Yeah.
Here we go.
All right. Why don't I'm going to bring this all together in the next few minutes. So first of all, I want to thank everybody for staying extra time. I think, obviously it was very valuable sticking longer with Pete as he was going through the task-based simulations. I want to thank everybody for joining us today. We know that a lot of you are already in UWorld. And so thank you for our current customers. We hope this added even more value that you got to come to the live event. And for those of you that have not enrolled in UWorld yet, it's a great opportunity to learn a little bit more. You obviously got a sample today from Peter with his lecture. And then what I'm going to talk about is a little bit more about some of our course features that you would experience as a UWorld candidate. So the first is that every time that you are approaching, getting ready to sit for any one of your 4 exam sections, you want to make sure you first and foremost have a plan. The number one question that we get when we go into firms and on campus is, how much time is this going to take me? What is my life going to look like? Well, as much as I hate to say it, but every time I do, it depends. Because at UWorld, what we do is we create a custom schedule based on you. How much time can you give us every day of the week or certain days of the week set against your exam goal? So when you log in and you get started, the first thing we're going to do is you're going to work through picking set schedule, flexible, or custom schedule. And then you're going to put in, as mentioned, when are you going to start studying and what is your exam date? Then from there, you are committing to yourself. Essentially, how many hours per week do you have to study? You can see in this example, I've got 5 hours on Monday, 2 on Tuesday. Good thing I'm taking Sunday off. Overall, in order to hit my goal in this example, it's going to take me about 18 hours a week. Then from there, every day that I log in, I'm going to get very clear cut. Here's my assignments, here's my videos to watch, the book to read, the questions to practice, and so on. So it takes out all the mystery to ensure that you're ready to hit your targets and manage your time effectively while in the course. Peter mentioned this a few times today during consolidations, but you'll see everything is going to point to the AICPA blueprints, right? The AICPA blueprints dictate what is on the exam and what you are going to be tested on. In every component of the UWorld course, the lecture, videos, the book, the questions, it is going to constantly point back to why are you having to learn this, and then how are you going to be tested on exam day. So for example, multiple choice question or one of the more difficult task-based simulations. So apples to apples, the blueprints are going to be outlined, and then our course is structured specific to that exact outline. If it's not in the blueprints and it's not on the new 2024 Evolution exam, it's not going to be included in your UWorld course. You'll see here, in addition to Peter, I'm very excited. Obviously, Dr. Megan Burke, she's down there in the middle on the bottom row. Peter up in the top corner, Roger Phillip, and a wide variety of authors, educators from some of the top schools throughout the country, and professionals, all dedicated to ensuring that this difficult content really makes sense and resonates so that you can actively apply it come exam day. You'll see there too, as Peter, I think you kind of mentioned it in one way or another, but everyone is a CPA, all worked in public accounting with experience in their fields. Very important. So it's not just a matter of being a good teacher or educator. Okay.
I'm sorry, Sharp. All our instructors did what? Yeah, they worked in public accounting. If they teach tax, they did tax returns. If they're trying to teach audit, they actually did an audit. They worked in public accounting. That's right. You want to mess with me? Come on, baby. Let's go. Fake. Come on.
as Pete said. So everyone worked in public accounting and all CPA, very, very proud of all of our instructors that work alongside Megan and Pete in our course. So let's jump into the questions. You all got actually a walkthrough of some of the questions, but within UWorld, one of the key differentiators from us from any of the other review providers is our active learning methodology. And so it's really important that you don't memorize the questions, memorize the answers, but that you actually are understanding the concepts so that you apply them on exam day. So you'll see here, this is an example in a UWorld question. And as we go through it, you'll see there that the question format matches the exam. No need to get used to UWorld. We need to get you used to the Prometric Testing Center environment. Immediate performance feedback. So this is one of our students and candidates' favorite features. So as you're going through the problem and you choose your answer, it's also going to tell you what percentage of other UWorlders also selected that answer. That will help gauge, the level of difficulty within the problem. From there, within the answer explanations, it's going to start out with a vivid illustration, a graph, a chart, some sort of picture that's going to really help make the concept and the answer come to life. Then we're going to go into an in-depth answer explanation. So at UWorld, one of our top focuses is we actually believe that we can teach you almost entirely through the quality of the answer questions, right? So very thorough, affirming why the correct answer is correct. And then you'll see here at the bottom, in addition to, great, you got the answer correct and here's why, it's equally as important to show you why the alternative answers are wrong. Very important. A lot of our candidates come back, say that's their favorite features, because if they're getting it right, that feels great. But when you're getting it wrong, you don't want to keep applying the same wrong logic as you're moving through the questions. Beyond there, you'll see every question includes a things to remember, which is a key takeaway. Every question is referencing to the blueprint. So again, why am I learning this and how am I going to be tested? And then at the very bottom down there, you'll see every question is tagged to the lecture video. So you watch Peter teach the lecture on consolidations, you go practice the questions, you're doing really well, and then you get a couple bumps. You're having some trouble on the questions, you need a timeout, click on the lecture video, jump right back into the lecture video series where this question and this concept was taught. So everything is going to be connected to ensure that you're really mastering the concepts. Peter mentioned this quite a bit. Another area of our active learning is our task-based simulation mastery videos. So we have two types of videos in the UWorld course, all focused on TBS. The first, in our study resources, these are a little bit more generic. So when you have a document review simulation as a TBS, in general, this is how you're going to apply. Here's how you're going to strategically go after it and look for what they're asking, no matter what the actual topic is. On the other side, you'll see we actually have TBS mastery videos in the explanation. So you'll see Dr. Burke is familiar with these. She's featured in many of them. In those cases, she's opening up a TBS the same way that you saw Peter in today's demonstration, and she's actually going through the TBS with you, showing what to look for, how to answer the question, and to not get tripped up. So both are included in the UWorld courses. An example today on consolidations is a little bit like our live CPA Bootcamps. So our Elite Unlimited students in our course, you also have access to our live Bootcamps. You can RSVP for those, attend these live events, often taught by Peter and our other educators. And then also, of course, the recordings are always available for our students. All right, so at this point, I've set a plan. I'm going through the UWorld content. I'm doing the TBS videos. How do I know if I'm actually ready, right? So with UWorld, we provide what is called our SmartPath technology. So SmartPath is going to provide you with 2 specific targets for every chapter as you're working through. These targets are not just picked out of thin air. They are built based on candidates that have already passed the CPA exam with UWorld on the new 2024 evolution, post-evolution exam. So these targets are going to give you 2 data points to hit. We want to make sure you're showing proficiency. So are you getting the score that we're looking for? And the volume of questions that you've been practicing. So you got to practice the right volume. A lot of candidates, and Peter knows this and Megan knows this, they start the process thinking, I'm going to do thousands and thousands and thousands and thousands of questions over and over and over and over again. You are going to do a lot of questions, but you can reach a point of diminishing returns. It's the right amount of questions and the scores you're supposed to be hitting. So in this example, you'll see that you want to hit the target score and the volume number of questions attempted. Once you've hit both of those, equally important, SmartPath will actually tell you with confidence, it's time to move on to the next chapter. Okay, so that's going to be a main data point that you're going to be searching for as a UWorld candidate. Exam support, mock exams, exam simulations. So you're practicing, you're watching the videos, you're reading the book. Now we need to kind of get into that real game day environment. At UWorld, we provide two options, exam simulator and mock exams. Exam simulator, you can practice as many times as you want. You're basically saying, UWorld, serve me up 5 testlets. Let's go for a 4-hour experience. We're going to coach you, take off the smartwatch, get rid of the phone, practice being in that 4-hour environment. Exam simulation, or exam simulator, you can practice as much as you like. Mock exams, you're going to be provided 2 per core, 1 for each discipline, brand new questions you've never seen before, mimicking the real 4-hour experience. And then you're also going to get some data analysis on strengths and weaknesses at the end. So our strategy is we're going to coach you to be saving those mocks more towards closer to your exam day as you're practicing the material. You'll see here, I alluded a little bit to it, but I saved the best for last with our SmartPath. So UWorld, we're exceptionally proud of our 90% CPA exam pass rate. You'll see there with the 90% pass rate, it's going to be a combination of students that achieved at least that 75% target of their topic areas in SmartPath, practiced at least 75% of the Q bank, so not all of it, and then created a minimum of 100 short practice quizzes, which we create those for you in the study plan, and then time, study for at least 60 days within the course. Students that check those boxes, SmartPath, time, practice exams, and scores, we have over a 90% CPA exam pass rate. Our goal, Peter's, Megan's, myself, our entire team, is for you to be like Catherine Elizabeth, celebrating that you've passed all 4 parts of the CPA exam. To help you get started with the UWorld course, those of you that are joining today looking to switch from another provider or get started on your journey, I'm really excited to share with you a course discount. You'll see there you can use code FAR Lecture on our Elite Unlimited course. Elite Unlimited course, it includes everything you need to pass the CPA exam. I heard a lot of questions today, print books, ebooks, all the videos, SmartPath, mock exams, live events, everything that I've described plus more with an unlimited subscription. So you really don't have to worry about your course expiring. This is great, especially if you're a student, you're not ready to start exactly, but you're going to be starting here soon after the first of the year, or you're a little worried about that time management component. Your course subscription will never expire with the discount for $2,099 on the Elite Unlimited course. Couple more slides. We would love for you, if you are inspired by UWorld, you're currently in UWorld or you're looking to join UWorld in the future, we are growing our UWorld ambassador team. It's a great opportunity for you to earn a full elite course for free by representing UWorld as an ambassador. If you are a student and you are interested, we do need at least 1 year left until you graduate. But the good news is we also onboard firm ambassadors. So if you'd like to rep on behalf of UWorld, share your great experience and tell others about UWorld and really the difference it's made for you or will make for you in the future, really, really encourage you to scan that QR code. It's really easy to apply for an ambassador position, and then our team will be following up with you for more information on how to get that started. Lastly, this is the first of a few FAR lecture series. So many of you may be joining us today because you saw that Peter put on LinkedIn, what do you want me to teach? And we took all of that information from Peter and we're giving you exactly what everyone's asking for. So you'll see consolidations up today. Next, we have bonds, then leases, statement of cash flows. If you enjoyed today, I would highly encourage you, invite friends, make a party out of it, make a watch party out of watching Peter teach bonds in January. Okay, so you should sign up for the future sessions, and then also please invite and encourage your colleagues, other students, professors, and your friends to join the next series that we're going to be offering. Lastly, here, as you'll see 2 QR codes. If you're ready to enroll, some more information, definitely applying that discount code. We'd also be interested, if you're interested in partnering with us, so if you're joining us today from a state society, a firm, a company, a university, all of the above, and you're interested in partnering with UWorld to bring sessions like this from Peter to your students or to your colleagues or employees, really encourage you there to scan the Partner With Us code. We can get you started learning a little bit more about our services and exclusive discounts as a UWorld partner to get started. So with that, again, thank you. My name is Charlotte. I'm our VP of e-learning. I'm going to give it back to Peter one more time, but I want to thank everybody for spending extra time with us today.
Thank you so much, Char. You are the best of the best.